You know, when we talk about corporate finance and accounting, one term that often comes up is standard costing. Now, if you've ever worked in a finance department or even just had a casual chat with someone in that field, you might have heard how standard costing is this magical tool for managing and controlling expenses. It's like the holy grail for finance teams trying to keep everything in check. But let's break it down a bit and explore the real implications of relying too heavily on this approach, especially when it comes to balancing short-term gains with long-term goals. So, what exactly is standard costing? Imagine you're running a bakery. You estimate that each loaf of bread costs a certain amount to make. Let's say $2 for ingredients, labor, and overhead. That's your standard cost. When you actually bake a loaf and it costs you 2 to 50 cents, you have a variance of 50 cents. This is where the charm of standard costing comes in. It gives you a clear, quantifiable framework to manage your daily expenses. You can pinpoint where you're overspending, investigate why, and take action to fix it. It's like having a financial GPS that helps you navigate through the day-to-day chaos of business. And let's be honest, who doesn't love seeing those immediate improvements in profitability? When finance teams use standard costing, they can quickly identify inefficiencies and initiate corrective measures. If your bakery starts seeing higher labor costs, maybe it's time to look into better training for your staff or even invest in some automation. The result? You boost your short-term efficiency and profitability, and everyone's happy, right? But here's where things get a little tricky. While standard costing can lead to immediate financial improvements, it can also create a short-sighted mindset. If you're constantly chasing those short-term savings, you might lose sight of your long-term goals. Picture this. Your bakery is so focused on minimizing costs that you decide to cut back on your ingredient quality to meet those standard costs. Sure, you might save a few bucks today, but what happens when your customers start noticing the difference? They might choose to buy their bread from a competitor who uses better ingredients. Suddenly, your short-term savings have led to long-term losses. Yikes! And it's not just about product quality. Think about how this short-term focus can affect your team. If you're not investing in employee training or new equipment because you're too busy trying to hit those cost benchmarks, you're setting yourself up for failure down the road. Your team might become less skilled, your processes might become outdated, and your business could struggle to adapt to changing market conditions. It's like trying to run a marathon while only focusing on that first mile. You might sprint ahead at first, but eventually you'll run out of steam. So, how do we strike that balance between short-term cost optimization and long-term financial goals? First, it's crucial to align your standard costing practices with your strategic objectives. This means thinking about what your business really stands for. If your bakery prides itself on using organic ingredients, then your standard cost should reflect that commitment. Sure, you might incur higher expenses in the short term, but the payoff could be a loyal customer base that values quality over price. It's about embedding your strategic priorities into your cost management framework. Next, we need to foster a culture of continuous improvement. This isn't just a one-and-done approach. The business environment is constantly changing, and so should your standard costing practices. Regularly review and update your assumptions. If the price of flour goes up, adjust your costs accordingly. If you discover a more efficient way to bake bread, factor that into your standard costs. This proactive approach ensures you're not just reacting to variances, but actively managing them in a way that supports both your short-term and long-term goals. And let's not forget about collaboration. Breaking down silos between departments can lead to innovative solutions. Imagine your finance team sitting down with your operations team and discussing how to improve efficiency without sacrificing quality. Maybe they come up with a new process that saves time and money while maintaining your brand's integrity. By involving different perspectives in the standard costing process, you create a shared understanding and accountability that benefits the entire organization. Now, let's talk about budgeting and forecasting. Traditional budgeting models can be a bit rigid, right? They often rely on static standard costs that don't account for the dynamic nature of our businesses. Instead, consider adopting flexible budgeting techniques. For instance, you could use variable standard costs that adjust based on production volumes or market conditions. This allows you to remain agile while still keeping an eye on your long-term objectives. And don't forget about rolling forecasts. Updating your financial projections regularly can help you stay aligned with your strategic goals while also responding to short-term changes. In conclusion, the world of business finance is a delicate balancing act. Standard costing can be a powerful tool for managing expenses, but it's essential to avoid falling into the trap of short-term thinking. By aligning your cost management practices with your long-term strategic goals, fostering a culture of continuous improvement, encouraging cross-functional collaboration, and embracing flexible budgeting, you can create a sustainable financial strategy that not only enhances your short-term performance, but also positions your business for lasting success. So the next time you find yourself knee-deep in spreadsheets and cost variances, remember, it's not just about the numbers. It's about crafting a vision for your business that balances immediate needs with future aspirations, and that's where the real magic happens.